Ken and I should thank our wives, Eileen and Freda, for their patience, which is enormous, and for their tolerance for us to not only spend our time on the business, but to also spend our time on research that relates to article publication. So thanks to our wives. As you enjoy your lunch this afternoon, Ken and I hope to provide you some additional food for thought. First, we'd like to start off with some quotes about the impact of leverage on capital markets. First, from an attorney who represents an investor in financial cases. When you add leverage on top of leverage and then add more leverage, it usually doesn't end well. And of course, from Warren Buffett, when you combine ignorance and leverage, you can get some pretty interesting results. First, we'll discuss an overview, which includes talking about the unique risks of leverage. We'll talk about the conventional approach, which is the mean variance model, and we'll consider the conventional approach using constraints on leverage to control the amount of leverage that's in the portfolio. Then we'll talk about our proposed approach, which is the Mean-Variance-Leverage model. And what we'll do is evaluate portfolios for investors who are averse to leverage, and we'll also optimize portfolios for investors who are averse to leverage. And that's a key distinction between evaluating portfolios for such investors and optimizing, which would be to form the best portfolio, the best risk-return trade-off. And we'll compare and contrast these two models, the mean variance model and the mean variance leverage model. So let's first talk about conventional portfolio theory and practice. Now, we're very fortunate today. We're going to be talking about modern portfolio theory, MPT. And we have Harry Markowitz with us today, and we're so delighted he's with us. He is literally the father of modern portfolio theory, which is the foundational model in modern finance. And his work was done and published back in 1952 in the Journal of Finance. Now, investors who behave according to modern portfolio theory, they prefer higher expected portfolio returns, which we'll refer to as mean returns. And investors dislike higher portfolio volatility, and that's because the investors have risk aversion, and will measure portfolio volatility by the variance of returns. Now, MPT allows a trade-off between portfolio expected return and portfolio volatility. And the way that trade-off happens is that for investors' degrees of risk aversion, there'll be a greater penalty for taking on higher levels of portfolio volatility. And we'll use mean variance optimization, which we'll refer to as MV optimization. We need to distinguish between MV and what we'll refer to as MVL for mean variance leverage optimization. So we'll consider mean variance optimization to find the investor's optimal portfolio, which, as I mentioned earlier, will be the portfolio that has the best trade-off between volatility and expected return. Now we'll talk about portfolios that have leverage. The leverage can be created in different ways. It can be created by borrowing cash to purchase additional securities long, or alternatively, borrowing stock to sell short. Of course, one employs leverage with the hope of increasing expected portfolio return. And we'll consider the following two portfolios, portfolios A and B, very simple examples. Portfolio A is a long-only portfolio. Let's assume that it is an expected return of 5%, and a standard deviation, which is the measure of volatility, which is the square root of variance, of 7%. So portfolio A has no leverage. It is long only. Portfolio B, on the other hand, is a leveraged long-short portfolio. That means it has long positions, and it also has short positions. Notice the expected return is 5%, the volatility or standard deviation 7%. So they obtain the same expected return and standard deviation. Now, if we consider mean variance theory, the investor would be indifferent between these two portfolios. And that's because in mean variance, there's a consideration of the mean or expected return and a consideration of the variance or volatility. But there is not any consideration of whether there's leverage present. What would most investors prefer? Well, if you can obtain the same expected return and the same volatility of return with portfolio A without taking on any leverage, one might assume that portfolio A would be preferred to portfolio B. Now let's take a look at the components of risk that are unique to using leverage. These include the risks and costs of margin calls. Margin calls can force borrowers to liquidate securities at adverse prices due to illiquidity. So what happens is there's a margin call. Usually it occurs at the worst possible time. Usually many investors are getting margin calls, and as a result, they're all forced to sell. So if you've leveraged with long positions, prices are plummeting, there are a lot of sellers, everyone's selling at the same time, you're going to be obtaining a very low price. Or if you have short positions and the prices are rising, then you're going to be forced to cover at a high price. In either case, when you obtain the margin call, there's the illiquidity and the costs associated with liquidation. Now, when things are going against you, when you're leveraged, you can also lose more than your initial capital. Moreover, there's the possibility of bankruptcy. If you can't cover your obligations, then you're going to be forced into bankruptcy. So let's take a look at some cases where there have been excessive leverage, which has given rise to systemic risk, and we've seen that systemic risk can affect world economies. So first, let's talk about the crash of '29. Well, individual investors borrowed a lot of money on margin at the time. When they received the margin calls, there was forced selling, and the market continued to plummet, and the losses continued to accrue. Long-term capital management is an infamous case in 1998 of a giant hedge fund. It was leveraged 25-1, and it ended up collapsing. The Goldman Sachs Global Equity Opportunities Fund is another case that was leveraged 6-1, and it required a $3 billion infusion. The whole leveraged securitized housing debt that we all know too well, 2007, 2008, with a highly leveraged housing sector, all the mortgages packaged as securities, and all those mortgages collapsing. How did it affect Wall Street? Bear Stearns and Lehman, very highly leveraged Wall Street institutions, burdened with these collapsing mortgages. Bear was ultimately bought out. Lehman went bankrupt. More recently, the J.P. Morgan whale, the London whale trader, made huge leverage bets on credit default swaps that led to billions of dollars in losses. So we've seen that there have been many catastrophes caused by excessive leverage, and that excessive leverage can give rise to systemic risk, market disruptions, and economic crises. Now let's talk about 3 solutions for the leverage problem. One solution is to use traditional mean variance optimization with a leverage constraint. That will control the amount of leverage in your portfolio. But the question is, what is the optimal level for that leverage constraint? An alternative method is to introduce a third dimension to portfolio theory and practice, which would be introducing a leverage aversion term. This results in the mean-variance-leverage optimization model that I mentioned before. A third alternative has recently been proposed by none other than Harry Markowitz, which is to build a stochastic margin call model, and that model would anticipate portfolio margin calls, and it would include a short-term measure of volatility, which would be a third dimension. However, that's a formidable problem that's yet to be solved.
Let's start with a review of the conventional mean variance model. The goal is to maximize utility, which is a fancy way of saying investor happiness or satisfaction. And investor utility consists of two terms. Investors like mean or higher expected return, and they dislike variance or volatility. And so the first term measures the preference of investors for higher returns, and the second term measures their aversion to volatility. The portfolio expected return, alpha subscript P, is the portfolio's expected active return in excess of a benchmark, and it's calculated simply as a weighted average of the expected returns of all the constituent securities weighted by their respective weights in the portfolio. You'll notice the second term has a negative sign simply because investors are averse to volatility, and that's the volatility term. Sigma P squared is the variance of the portfolio's active return. And it consists of, it's calculated simply based on the covariances of all the various securities and the respective weights in the portfolio. And finally, there's that term tau subscript V, which is the investor's tolerance for volatility. It simply measures, for a particular investor, the trade-off they prefer between higher rewards and a preference for less risk. During the talk today, we're going to refer to investors who use this utility function as MV, or mean variance investors. The portfolios they form, the optimal portfolios they prefer, we'll refer to as MV portfolios, and the utility they derive from those portfolios we'll refer to as MV utility, where in each case tau sub V is that investor's particular tolerance for volatility. Now let's apply this mean variance analysis to portfolios with leverage. We're going to use an example of an enhanced active equity portfolio structure. Many of you are familiar with a 130-30 type portfolio. And we're going to use this example without loss of generality. The basic results we're going to report today would hold for any portfolio with leverage. But to make things concrete, we're going to use a 130-30 example. And as you may know, this sort of a portfolio would have 130% of capital invested long in attractive securities, 30% of capital invested short in unattractive securities. So the total portfolio has 160% of positions, or 60% in excess of the original capital. And we'll refer to that 60% excess as leverage, or Greek letter lambda. We're also going to define the enhancement as leverage divided by 2, or in this case 30%. So in other words, a 130-30 portfolio would have an enhancement of 30%. Now you'll note that one neat feature of the structure is that the net long exposures minus the net short exposures, 130 minus 30, equals 100%, or a full market exposure. And finally, we're going to constrain the beta, or market sensitivity, of these portfolios to be 1. This slide describes the data and estimation procedures we used in our analysis. The first bullet simply explains that we're using S&P 100 stocks. This is a very conservative set of large-cap U.S. equities. The next 3 bullets spell out the estimation procedure. There's a reference if you want more details. The next bullet talks about diversification. In much of what we do, we want to have diversified portfolios, and so we achieve that by applying a constraint that no security can have a weight more than 10% above or below its weight in the index. So for example, if IBM is 3% of the index, we wouldn't want to hold more than 3 plus 10 or 13% long. And if we disliked IBM, we wouldn't want to hold more than 3 minus 10 or 7% short. Now, this is an assumption we're generally going to use in our talk today. There's a few slides where we're going to remove this 10% constraint to see the effect of removing it, because we get some interesting findings. But in general, if we don't say otherwise, this 10% security constraint will be binding in all of our findings. And then the last point is that we're assuming costless self-financing, which means we're assuming the proceeds from the 30% short are sufficient to fund the 30% long. In other words, we're assuming no stock loan fees or brokerage expenses, et cetera, which obviously would hold in the real world. But for illustration, we're going to assume all that away to see what we see. So what we have here are efficient frontiers for various leverage constraints. Starting with the axes, the x-axis, the standard deviation of active return, is simply a measure of risk, as Bruce described it. And the y-axis is a measure of expected active return. That's what investors want, is higher return, and they prefer less risk. So if we start with the lowest curve, that's the example of a 100-0 portfolio, or a long-only portfolio where leverage is 0. Every point on that curve represents an optimal portfolio, and where an investor chooses to be located on that curve depends on their tolerance for volatility or their particular trade-off between risk and reward. So an investor who's very averse to risk would want to be way down on the left. An investor who's more tolerant of risk would be further out on the right. So this is the familiar trade-off we all know between risk and reward. Now, if you look at efficient frontiers where you're constraining leverage to be higher and higher, you see that the efficient frontiers rise. So for example, the 130-30 frontier, where the leverage is 60%, is a higher frontier than the 120-20, which is higher than 110-10, et cetera. And so one interesting thing that means is for any given level of risk, say 4%, the more leverage you permit, the higher the return you can achieve. Let's consider now a particular investor, an investor with a volatility tolerance of 1, what we refer to as an MV1 investor. And let's say, again, you're varying the leverage constraint to different levels. What we show here, labeled A through F, are the optimal portfolios for this particular investor. If you force this investor to have no leverage, they're going to be on the bottom curve, and in fact, their favorite portfolio on that curve will be portfolio A. If you constrain leverage to be 60%, they'll be on the 130-30 curve, and their preferred portfolio will be D, et cetera. So you'll notice that as leverage is constrained at higher and higher levels, volatility increases, the standard deviation increases of the portfolio, and the expected return increases as well. So a natural question is, where does this all lead? What happens as you force leverage to be higher and higher? Where does this go? So I'm going to ask you to focus first on the solid line, which is again the 10% security weight constraint case. And we've changed the axes a little bit here. Previously, you recall, the frontiers we showed were 110-10, 120-20, so the enhancements were 10 or 20 or 30 up to 50%. Here on the x-axis, we're permitting enhancement to go all the way up to 500%. And the y-axis is now utility, or the goodness of each of these portfolios from the perspective of this investor who has a mean variance utility function with a volatility tolerance of 1. So again, you can see those portfolios, little a through F, on the far left of the slide. And you can see that the investor is happier and happier as they take on more leverage. The utility is rising. And in fact, it continues to rise all the way out to portfolio Z. Z is the optimal portfolio for this MV1 investor. And Z is a fairly highly levered portfolio. It has an enhancement almost 400%. So it's a 500-400 portfolio, roughly speaking, with leverage of about 8-to-1. Another interesting feature is you'll see that the utility curve drops off pretty steeply as leverage continues beyond that point. Why is that? You'll recall that we're constraining active weights to be no more than 10% in any security. So what happens as you continue adding leverage to a portfolio is you have more money to put out and you're taking on more, you're investing more and more in positions. So originally you're buying your best securities long and selling short the securities you like the least. But eventually, you're going to start bumping up against those 10% constraints in some of those securities. And when that happens, you have to start buying the second best and third best and fourth best securities. And finally, when you have so much money, it gets to a point where you're forced to invest in securities you actually don't like, simply because the leverage is forcing you to invest, and all the good ones are taken, so you have to put it somewhere. And that's why the line drops off. Now, if you look at the dashed line, the dashed line removes that 10% active security weight constraint. In other words, you can put as much money as you want into any security, and you can see that that line rises almost linearly. It appears to be linear. In fact, it's not quite linear. It's gradually slowing down, and it's going to peak somewhere out on Broadway, way, way out there, at about 91 times leverage. So an interesting question is why, if you can buy as much as you want of the best securities and short as much as you want of the worst securities, why doesn't that keep going up forever? And the answer is actually back on the prior slide, where you'll recall that as you take on more and more leverage, your expected return is going higher and higher, but also your volatility is going higher and higher. And while you like more return, you dislike volatility. And eventually that volatility term dominates and utility turns down. Let's look at the characteristics of those optimal portfolios. Going back to the solid line, the portfolios A through F all the way out to Z. And this exhibit shows the characteristics of those portfolios. Each row represents a portfolio. And we show their enhancement and their risk and their reward, et cetera. And again, this is from the perspective of an investor with a volatility tolerance of 1. If you look at the last column, that shows the utility or the goodness of each of these portfolios for that investor, for their particular utility function. And again, you can see that they're happier and happier as you move from A through Z, Z having the highest utility of all those portfolios shown. But a natural question is, okay, portfolio Z is optimal for a mean variance investor with volatility tolerance of 1, but what if that investor also has an aversion to the unique risks of leverage? Which of these would they prefer? Mean variance analysis can't answer this question, hence the need for mean variance leverage analysis.
So as Ken said, we're going to talk now about mean variance leverage analysis. So we need a mean variance leverage utility function. And the first two terms will be familiar because they're from mean variance analysis. The first term is a preference for higher expected return. The second term, which has a negative sign, is an aversion to volatility. And the third term, which also has a negative sign, is an aversion to leverage risk. Now let's examine this third term in more detail. So we see sigma sub t squared, which is the total return volatility squared, and we see lambda squared, which is the measure of leverage to the square power. Now in terms of sigma sub t squared, the variance of the leverage portfolio's total return, we see the formula shown, where it takes into account the covariance between the total returns of the securities, and it also takes into account the holding weights of the securities. And then we define lambda squared as the square of the portfolio's leverage. Now first, why do we look at total return? It's important to look at the variance of total return because it's total return which can give rise to a margin call. We wouldn't want to just look at an active return measure. And why are we squaring? Well, you'll notice for the second term, for volatility, it's the square of standard deviation. So we have a similar format here. And the intuition behind that is that as you take on more volatility risk, there's more and more a chance of a margin call. And as you take on more leverage, there's more and more of a chance of a margin call as well. And then beyond that, why are we looking at the product of total return variance times leverage squared? And it's because if you lever more volatile securities, you're much more likely to have a margin call than if you leverage stable securities. Now what we're pointing to is tau sub L. This is the investor's leverage tolerance. So just as in the second term, there was a tolerance for volatility, now we have a tolerance for the unique risks of leverage. And analogously, for the mean variance model in terms of our notation, we'll be referring to MVL tau sub V, tau sub L investors with levels of volatility tolerance and leverage tolerance. And those investors prefer MVL optimal portfolios, which will have an MVL level of utility. Now, in Ken's example before with mean variance analysis, he showed that utility increases with leverage. Now we're going to see the effect of this third term, of bringing a leverage aversion term into play. So we're looking at these portfolios A through F that Ken described before, but previously utility was higher for each one of these portfolios as you move successively out to portfolio F. What we're finding now when we evaluate these portfolios with an MVL11 utility function, meaning mean variance leverage for an investor with a volatility tolerance of 1 and a leverage tolerance of 1, when we evaluate those leverage-constrained MV1 portfolios, because of that third term, the curve turns down. That's due to the disutility associated with taking on leverage risk, which becomes an offset to the higher expected return as you take on more enhancement. We see at the peak, we have a portfolio labeled lowercase g. That portfolio is the portfolio that would be optimal for an MVL11 investor who's considering these mean variance portfolios that were leverage constrained. That's the portfolio that you'd want using this evaluative function of a mean variance leverage utility function. And that portfolio is a 129-29 portfolio, meaning 129% long positions, 29% short positions, for an enhancement of 29%. Now let's re-examine the characteristics of the optimal mean variance portfolios that Ken spoke about, but from the perspective of this mean variance leverage investor. So what's new in this table compared to the table that Ken showed earlier is the last column on the right. It's the utility for the MVL11 investor. How much happiness do you get from these portfolios A through F? And you can see that for portfolio G, the utility is its highest at 3.39. And this occurs because we've taken into account the investor leverage aversion. Now let's consider the relationship between the mean variance model and the mean variance leverage optimization model. What we'll find is that the mean variance model is a special case of the mean variance leverage optimization model. In fact, there are two special cases. One case is where the investor has zero leverage tolerance. This means the investor dislikes leverage. The investor doesn't want to take on any leverage at all. This is when tau sub L, the leverage tolerance of the investor, is near zero or at zero. If you consider this third term, where tau sub L is near zero, that third term, because tau sub L is in the denominator, will become very large, and the optimizer will seek to minimize that third term. And that third term will be minimized by taking lambda, the level of leverage, to zero. And that makes sense because this investor has zero tolerance for leverage. This investor dislikes leverage, won't want to take on any leverage, and will hold a long-only portfolio. But when that third term goes away because the leverage is zero, you see that the utility formula will be like the mean variance formula. It will have the first two terms, but it won't have the third term. So leverage tolerance at zero is indeed a special case of the broader mean variance leverage optimization model for long-only portfolios. There's also another special case, which is when the investor has infinite leverage tolerance. In this case, the investor is not concerned with the amount of leverage that's present in the portfolio. And tau sub L, the level of leverage tolerance, goes to infinity, infinitely tolerant of leverage. Well, now let's look at the third term again. When tau sub L is infinity, that third term will go away again because you're dividing by such a large number. And when the third term goes away, it means you'll be left with the first two terms. And the first two terms is mean variance utility. And we've seen that when you have infinite leverage tolerance, as Ken showed an example earlier, with no constraint on the security active weights, that the level of leverage can be as high as 91 to 1. So what can we conclude? That mean variance optimization and mean variance leverage optimization produce the same portfolio in these two special cases, and only in these two special cases, which suggests that mean variance optimization is appropriate for long-only portfolios. Mean variance optimization is appropriate if an investor is not concerned about leverage. Now, as to solving the mean variance leverage optimization problem, it is a more complicated problem to solve than the mean variance problem. We can see that for mean variance, it's a quadratic mathematical formulation, because you'll see that in the second term of the utility function, there's an x sub I and an x sub j. That's what makes it quadratic, because there's a squaring taking place. And you can use a quadratic solver to solve it. However, for the mean variance leverage problem, it's not quadratic, it's a quartic mathematical problem. And you can see in the third term that there's an x sub I, an x sub j, and then within the absolute value signs, another x sub I, which is squared. So the variables are to the fourth power. And in order to solve this, we used a technique called fixed point iteration, which allows a quadratic solver to be applied on an iterative basis.
So now that Bruce has shown you all how to solve the MVL problem, let's take a look at some mean variance leverage efficient frontiers for investors with various leverage tolerances. And we're going to start with one of the special cases that Bruce discussed, an investor with zero leverage tolerance. This can be solved, as Bruce said, either with mean variance leverage optimization or mean variance with a constraint of leverage equals zero. And you see the familiar efficient frontier. For an investor who has absolutely no tolerance for volatility risk, they're going to sit at the origin with zero standard deviation of active return and zero expected active return. In other words, they're going to hold an index fund. And as investors' volatility tolerance increases, they're going to move out that efficient frontier and take on higher and higher levels of volatility risk and earn higher and higher expected active rewards. And you'll see that at every point along that curve, it's a 100-0 long-only portfolio. The next case is an investor with a leverage tolerance of 1. This can only be solved with MVL optimization. And once again, if the investor has no tolerance for volatility, they'll be at the origin holding an index fund. And as they become more tolerant of volatility, they'll move out the efficient frontier taking on higher and higher levels of volatility risk, getting higher and higher levels of expected return. But the one thing that's really interesting here, remember, we're holding leverage tolerance constant. All we're varying, moving along that curve, is volatility tolerance. And yet as we increase the volatility tolerance, you'll see the investor takes on more and more levels of leverage, moving from long only to 110-10 to 120-20, et cetera. As we continue to increase leverage tolerance, the curves continue to shift around, and we'll now take it to the other extreme, which is where leverage tolerance is infinite. This is the second special case that Bruce mentioned, and again, you can solve this with mean variance or mean variance leverage optimization. And once again, you have the index fund at the origin, higher and higher levels of enhancement, higher and higher levels of volatility risk, and higher levels of expected return. All those slides were holding the 10% security active weight constraint. Now we're going to look at the case where leverage tolerance is infinite, and we're removing the 10% active weight constraint. So you can hold as much as you like of any security. And interestingly, the efficient frontier becomes a straight line. Once again, it terminates at the origin with an index fund. For an investor who is totally intolerant to volatility, they'll hold an index fund. But for any other investor with any non-zero tolerance for volatility, they're going to hold an active portfolio. And what's interesting is that's the same portfolio anywhere on that curve, just with the active weights levered up more and more and more. But it's the same proportionate active weights in any of those portfolios because there's no constraint on how much you can hold of any portfolio. So once you find the optimal combination, you just keep levering it more and more as you move out. And you can see the enhancement gets very high in this particular example. By way of a quick review, the top left, example 1, was the conventional long-only frontier. We're all familiar with that. The top right is an example with some leverage aversion. In that case, tau sub L equals 1. And again, we get a very reasonable efficient frontier. And in fact, you'll note that the levels of enhancement shown are very commonly used in practice. 110-10, 120-20, 130-30. Those tend to be the kind of portfolios you actually see with this sort of structure. And in the third and fourth exhibits, when you allow infinite leverage tolerance, where there's no aversion to the unique risks of leverage, you can see that the enhancement gets very, very high, potentially.
So let's pick up now on where Ken left off. We're going to look at various mean variance leverage efficient frontiers for different leverage tolerance cases, and we will take into account that there is a 10% security active weight constraint that's present. Now, the efficient frontier shown at tau sub L equals 0 and the efficient frontier shown at tau sub L equal 1 are actually identical to the efficient frontiers that Ken showed earlier. What we've added in here is some additional efficient frontiers. And what we've also done is to identify certain portfolios. So we've identified portfolio A, B, and C. With traditional mean variance analysis, we would all recognize that we would typically think that portfolio B would be preferred to portfolio A, because portfolio B offers at the same level of standard deviation of active return, that is at the same level of volatility, portfolio B offers a higher expected return. And if you can get a higher expected return at the same level of risk, it would appear to be better. And we would also conclude with traditional mean variance analysis that portfolio C is preferred to portfolio A because they both offer the same expected active return. However, portfolio C entails less volatility. However, if as an investor your tolerance for leverage is 1.0, you're not going to prefer B or C over A. Instead, you're going to prefer A over B or C. And that's just because your level of tolerance for volatility is 1. Now, if your level of tolerance for leverage is 2, then you would prefer B or C over A. But if your tolerance for leverage is 1, you'll indeed prefer A. Also, somewhat difficult perhaps to notice, but I'll comment on this more later, is that as you look at these efficient frontiers, they seem to be a little bumpy or they have some kinks. They're not perfectly smooth. So let's take a look at this again in terms of the preference if you're an investor with a leverage tolerance of 1 that you prefer A over B or C. We've indicated the leverage tolerance and the volatility tolerance for portfolios A, B, and C. And we've indicated the enhanced active equity structure being for portfolio A 125-25 portfolio, portfolio B a 139-39 portfolio, and portfolio C a 135-35 portfolio. We also show in blue that A and B have the same volatility and that A and C have the same expected return. And we had said before, if you're an investor with a leverage tolerance of 1, you're going to prefer portfolio A over B or C. And what we find is that portfolio B and C take on more leverage. They have more positions long, more positions short. And so if your leverage tolerance is 1, you're going to prefer the 125 portfolio, 125-25 portfolio with 125 in positions long, 25 in positions short over B or C. And if you look at the rightmost column for the utility of investor A, where A is an investor that has a leverage tolerance of 1, you'll see that the utility or the happiness that's derived for that investor is greatest for portfolio A and is higher, of course, than portfolios B or C. Now what we've done is we show the same leverage tolerance efficient frontiers as before. Those are shown in black. Now, previously, when we looked at those frontiers, they were a little bit bumpy. Now those frontiers look much smoother. And that's because now, as we say in the title, we've lifted the security active weight constraint. There's no security active weight constraint present. So when there was a security active weight constraint present of 10%, as you moved out on that efficient frontier from left to right, you would be bumping up against an active weight constraint so that you wouldn't be able to purchase more certain desirable securities, and so the curve wasn't as smooth. But here, it's smoother. Now let's focus on the colored lines we show here, which in the legend we show as being for different levels of volatility tolerance. So we show volatility tolerance from 0.05 up to 2. It's depicted. Those curves are more vertical while the previous were more horizontal. And these are indeed efficient frontiers. They're efficient frontiers when you hold volatility tolerance constant at a certain level, and you move out on that frontier as your leverage tolerance increases. Now, the whole diagram we refer to as an efficient region, and it's bordered by the black lines and curves that are shown there. And it's an efficient region if your volatility tolerance ranges between 0 and 2, and your leverage tolerance ranges between 0 and 2. And we could identify a particular point where your leverage tolerance is 1, and now where your volatility tolerance is 1, it's on the aqua curve. So where they intersect, that your leverage tolerance is 1 and your volatility tolerance is 1, is where there would be the preferred mean-variance-leverage 1-1 portfolio for an investor that has a volatility tolerance of 1 and a leverage tolerance of 1. Now, so far we've been talking in terms of two-dimensional drawings, which are far easier to relate to, but we have built a model for optimization, which is a mean-variance-leverage model that actually has 3 dimensions. So we show here a 3-dimensional surface. On the right-hand side here, on the x-axis, we have volatility tolerance. On the left-hand side here, we have the y-axis for leverage tolerance. And on the z-axis, we have the enhancement. And we could show on the z-axis the standard deviation or the expected return, etc. And let's talk a little bit about the shape of this surface. Let's first talk about the case where the volatility tolerance is 0. When your volatility tolerance is 0, you don't want any active risk. So your enhancement will be 0, which is along the y-axis. And if your enhancement is 0, you don't want any volatility tolerance, then all those portfolios are index funds. No active risk. Now let's take the case where your leverage tolerance is 0. Here, you don't want any leverage. So all the portfolios along this x-axis would be long-only portfolios. Again, no enhancement, that is, there's no leverage that's present. Also, to assist you in reading this chart, perhaps it's worthwhile giving an example. So if your volatility tolerance is 2 and your leverage tolerance is 2, the question is, well, where would be your enhancement? It would be up in this corner, right here, a little above 50%. But you can see it's hard to read off the enhancement percentages from this 3-dimensional drawing, and we're going to address that shortly. Now, this has a very interesting shape, and we've identified the portfolios along each of the 2 axes, the x and the y axes. Let's talk about the portfolios along this curved axis on the left side. You can see that the enhancement percent, or the amount of leverage that's taken on, rises fairly quickly and fairly dramatically. Why is that? That's because all these portfolios on the y-axis down here are index funds. They have no active weights, no active management. And so as you permit some volatility tolerance, as your volatility tolerance increases, all of a sudden there's the willingness to take on some active volatility. And with that willingness, there's a dramatic increase in the opportunity present. And so all of a sudden you're taking on long and short positions, you're adding in the enhancement percentage, you're adding in some leverage. And so there's a very steep increase initially. Now let's take a look at the right-hand side. This is when we're increasing leverage tolerance. And as you increase your leverage tolerance, you can see there's a fairly continual increase in the amount of enhancement or leverage. That would be expected because you're willing to take on more leverage, and we've talked about cases of infinite leverage tolerance and taking on large amounts of leverage, such as 91 times your capital, 91 to 1. I'll show you another chart, which may take a little time to get used to, which can assist in reading the enhancement percentages, which will reduce this 3-dimensional surface to a 2-dimensional surface. And before I go there, I'd like to take a look at the enhancement percent when it's about 20%, which is where the aqua color is, or the bluish, the lighter blue color at a 20% level. What sort of volatility tolerance and leverage tolerance will give rise to a 20% enhancement? So this is what's referred to as a contour map. It's a contour map of the mean variance leverage optimal enhancement for various combinations of volatility tolerance and leverage tolerance. You can see where all the portfolios are for the 20% contour. there are various combinations of volatility tolerance and leverage tolerance which will give rise to that contour. And we can refer to this contour as an ISO enhancement contour because all along the contour, the enhancement level is the same at 20%. You can also see that as you increase your leverage tolerance, you rapidly increase your desired levels of enhancement or leverage. As you go vertically in this chart up, your enhancements increase from 10%, 15%, up to 50%. Now let's locate an optimal mean variance leverage portfolio for an investor with a volatility tolerance of 1 and a leverage tolerance of 1. What we've done is we've drawn in lines, black lines, where volatility tolerance is 1 and leverage tolerance is 1, and you can see they intersect at portfolio capital G. You can also see that there's a dashed line, and that dashed line represents the optimal level of enhancement for portfolio G. And that comes to a 129-29 portfolio. That is, the optimal enhancement is 29%. So out of all the portfolios on the surface, if you're an MVL11 investor, you would want capital G. Now let's take a look at the same contour map where we've located again capital G, which, as I said, is at an enhancement of 29%. Now there's a relationship between this G and the lowercase g that we discussed earlier when we looked at leverage-constrained MV1 portfolios. When we did that, we found that lowercase g at 29% enhancement was optimal. So it turns out that if you directly apply MVL, mean variance leverage, and optimize for an investor with a volatility tolerance of 1 and a leverage tolerance of 1, you'll get a 129-29 long-short portfolio. But also, if you use mean variance analysis and optimize leverage-constrained portfolios and evaluate those portfolios with a mean variance leverage utility function, what will also result is a 129-29 portfolio. Now, in all our discussions, we've looked at volatility tolerance between 0 and 2 and leverage tolerance between 0 and 2. And what we'd like to do from a graphical point of view is to extend the leverage tolerance to a larger number to see its effect on utility and ultimately on other characteristics of the portfolio. So we've graphed this here where you can see on the horizontal axis the leverage tolerance rises dramatically, well beyond 2 to 1,000. We could go out to a much bigger number. And we graph on the y-axis the mean variance leverage utility that's obtained. We also show a horizontal line at the top, which we'll refer to as an asymptote, where that asymptote is for a mean variance investor that has a volatility tolerance of 1. So what we see is that as the leverage tolerance increases, the MVL utility rises and then converges toward the asymptote. Now notice, as we say on the right-hand side, that the MV1 utility is the same as the mean variance leverage utility for an investor with a volatility tolerance of 1 and a leverage tolerance that's infinite. That was one of our special cases previously. When the investor has infinite leverage tolerance, we said a special case was that MVL reduces to MV, that is, reduces to mean variance. Now we can see on this chart that if your leverage tolerance is small, if it's 1 or 2, that there's a big difference in utility between the asymptote and the level of utility for that investor with a low level of leverage tolerance. And looking now at these 4 charts, the one that's on the bottom right is the chart that we saw a moment ago. And here in the other charts, we're plotting other portfolio characteristics for this MVL, mean variance leverage portfolio, for investors at different levels of leverage tolerance. And we show a chart on the top left for the enhancement, on the top right for the volatility, and the bottom left for the expected active return. And you can see if your leverage tolerance is low, say 1 or 2, that once again, there's a big difference between the mean variance portfolio represented by that horizontal asymptote on the top and the desirable portfolio for the investor that is averse to leverage and uses a mean variance leverage utility function. So we see that the results from mean variance are very different from the results from mean variance leverage.
So in conclusion, we find that mean variance optimization implicitly assumes either 0 leverage tolerance, meaning long only, or infinite leverage tolerance. We see that without a leverage constraint, mean variance optimization can result in highly levered portfolios. In one of the examples we showed, it was 91 times capital. With a leverage constraint, mean variance optimization will lead to the optimal portfolio for a leverage-averse investor only by chance. And what we need here is, Bruce showed an example where the optimal enhancement was 29%. If we use other examples with other samples of stock, other aversion parameters, you'll get a different number as being optimal for the enhancement. And unless you happen to guess that number and set the constraint at that number, the solution will not be optimal with mean variance. So there's 2 ways to identify the optimal portfolio for a leverage-averse investor. The first is to use mean variance to identify numerous portfolios, as we did lowercase a through g, and evaluate each of them with a mean variance leverage utility function, and we found that lowercase g was optimal. The other method is to use mean variance leverage optimization directly, and we found that capital G was optimal. And it turns out that both methods produce the same portfolio. Not only do little g and capital G have the same enhancement, they have the same holdings. They're, in fact, the same portfolio. Both volatility tolerance, or aversion to volatility, and leverage tolerance are critical for portfolio selection. And just as MPT says investors are willing to sacrifice some return in order to reduce volatility risk, in an MVL world, investors are willing to sacrifice some return in order to reduce leverage risk. And so what mean variance leverage optimization does is it balances expected return against both volatility risk and leverage risk. And we find that leverage aversion can have a very large effect on an investor's optimal portfolio. Finally, let's look at some polar cases of volatility risk and leverage risk. What we have here are 4 examples that run the gamut from very low leverage to very high leverage, and very low portfolio volatility to high portfolio volatility. So if we start with the top row, the upper left is a case with 0 leverage and very low portfolio volatility. This would be a long-only index fund. It's a very low-risk investment. There's not much to say about it. If you move to the right, we have an example of little or no leverage, but high portfolio volatility. This would be the case of many of Enron's employees who had much of their savings in company stock, and they learned the hard way how risky it can be to have an undiversified portfolio. The bottom left is an example of a highly levered portfolio consisting of very low volatility positions. This is long-term capital management. As Bruce said, they were levered 25 to 1, but their portfolio was very low. The underlying portfolio was very low risk. It was a well-diversified set of arbitrage opportunities, each of them individually very low risk, and yet it was levered so high that they did suffer from the unique risks of leverage, and the fund imploded. And the last example is a case of very high leverage combined with high portfolio volatility. This is the example of the CEO of Chesapeake Energy, who borrowed on margin to lever up his holdings of his own company's stock. The stock dropped. He suffered margin calls. He was forced to sell out at the bottom at a personal loss of almost $2 billion. So presumably none of us are at any of these extremes in terms of risk. We may have some leverage, either personally with a home mortgage, in our portfolios with short positions or some leverage. We may hold some volatile securities. The key is to make the optimal trade-off between volatility risk and leverage risk. And so to wrap it up as simply as possible, conventional portfolio theory says not to hold all your eggs in one basket. We would add that using excessive leverage is like piling baskets of eggs on top of one another until the pile becomes unsteady. Thank you.
So we'd like to open it up to questions at this time.
How sensitive is your enhancement to whether you're doing it on the S&P 100 or the S&P 500?
Well, we're using, as you know, for the S&P 100, a very conservative set of stocks, which is very meaningful in terms of the overweights and the underweights that are obtained and the amount of leverage that's possible. If we were to use a broader universe of more volatile stocks, you might expect that they would offer still higher expected returns for long positions or short positions, and as a result, there would be even more leverage.
Can you explain a skill-based transformation, just generally?
Yes.
And then also your intuition that you mentioned. Why is it a square function, not a cube, not a
Yes.
exponential, etc.?
Right. Well, the skill-based transformation is a way to take the actual returns, and instead of using, we use two years worth of daily data. And if we had used the actual returns, you get very extreme portfolios because one stock would have shot through the roof, other stocks would have gone bankrupt. And so while we did use the actual covariances and variances when it came to expected returns, we knew we needed to make a skill-based adjustment. So what we did is we had a random seed to create noise, and we maintained basically a correlation between predicted and actual of 0.1, which shows a reasonable level of insight. And the transformation is discussed in more detail in our first paper, which appeared in the Financial Analyst Journal. And in terms of the functional form, you can use other functional forms clearly. The question is, what's the best proxy? What we chose is consistent with what Harry Markowitz did in terms of squaring standard deviation for variance. We did the same with respect to the standard deviation of total return, and the same with respect to the amount of leverage that's present in the portfolio. But one could be still more averse to leverage with a cubic or a quartic sort of formulation. However, the general conclusions that we have will still hold in terms of the special cases, et cetera, and the analysis of MVL, mean variance leverage, to mean variance.
The tolerance of leverage may really depend on the market volatility. In other terms, or maybe we should say volatility and leverage, they're all sort of a dynamic variable. So how do you, handle this in your model?
This was a static example, a one-period kind of example. Obviously, if market volatility picks up, the sigma subscript t squared would get larger. But you're right. More or less enhancement or leverage would be optimal in high and low volatility regimes, and that's another challenge we face as investors, is knowing what world you're living in.
Right, so ours was looking at a particular period just to see what it implies about MVL versus MV.
My risk aversion coefficient is 2.5, and I assume that everyone knows that exactly too. And now we have to estimate another parameter. So I'm wondering how you would map a cost of leverage into that leverage coefficient.
One way to do it is by observing, showing you different portfolios and seeing which you like and which you don't like. Another way that Harry may get into later in his talk is with Monte Carlo simulation. You can take different parameters and generate portfolios and see what happens over the long run and look at the distributions and see which one you're most comfortable with.
You can look at your ending wealth distributions for different levels of the parameters.
It seems to me that you're not penalizing, the investor preference, usually there's aversion to higher moments. So here, I don't think you have aversion to skewness because leverage is kind of, you're saying leverage is bad when you introduce that constraint on both sides. So whether it's good market or turbulent market, you seem to be penalizing by the same amount, whereas there are other, as you probably know, utility functions that actually address both sort of skewness and kurtosis. Here I think you're addressing kurtosis, but not the skewness.
Well, you know, Harry might be one who would want to address that, as he has a new book out that deals with issues like that. That actually, you don't need normality in order to have mean variance as the appropriate formulation. All you need is a concave utility function. Harry, did you have some words?
The introduction to my new book says it's trying to clarify that our field is subject to what I call the great confusion, capital G, capital C. That's the confusion between the necessary and sufficient conditions for using mean variance. Gaussian distributions, normal distributions, are sufficient, but they're not necessary. If you believe, as I do, that one should maximize expected utility, not in the sense that you had up on the board, but in terms of the von Neumann utility function, then the necessary and sufficient condition for using mean variance is if you carefully pick a point off the efficient frontier, will you be closely approximating the expected utility of your concave risk-averse utility function, even though you have no idea what a utility function is. So in chapter 1 of the new book, the new book's coming out in 4 volumes, as you will see this afternoon, later this afternoon. And volume 1, I'll just tell you the 5 chapters. Chapter 1, why we believe in expected utility. Chapter 2 is a survey of mean variance approximations to expected utility for historical distributions, all sorts of things, whatever the moments were. And these mean variance approximations are very supportive of the various surveys of the efficacy of mean variance approximation have been very supportive. No textbook seems to know about it. Chapter 3, I do mean variance approximations to the expected log, which is the Bernoulli, original Bernoulli utility function, and of 6 different ways of knowing, and that's also the log of the geometric, 1 plus the geometric mean. So 6 different ways of of estimating expected mean, arithmetic mean and variance, and guessing geometric mean. I see 2 or 3 of them which are good, and 3 of them, the others are lousy. Chapter 4, I say, and I compare this with various databases. Chapter 4, I said, what if we use different measures of risk, like not only mean variance, but mean semi-variance, mean MAD, that's mean absolute deviation, mean VAR, mean CVAR. Which ones do best, in terms of databases? Mean variance does best, better than mean VAR. Mean variance better than CVAR. Okay, read the book. I'll show you the data. And then chapter 5 says, what are the probability distributions, sort of from a very broad class of Pearson family distributions, which ones have the highest likelihood of giving? So my gentleman back in the back is clearly subject to the great confusion, like many people are, and he should buy my book, which if you buy it from the publisher, it's $50. But if you buy it through Amazon.com, you can get it for $30 plus shipping.
Your zero volatility level is assuming long an index fund. Isn't it possible in some 130/30 or other format you could have greater numbers, greater amounts of lower volatility stocks while shorting some high volatility stocks, which would lead to an overall portfolio with less volatility?
It would have less total volatility, you're right. But what we're measuring is active volatility relative to benchmark, in this case the S&P 100. And the portfolio that has the least volatility relative to the S&P 100 has to be the S&P 100 index fund.
True, but for an extremely risk-averse investor, wouldn't some other format possibly be better?
Well, what we did here is we examined mean variance and mean variance leverage, all in the context of what we call enhanced active equity portfolios, where you have some additional longs and you have additional short positions, and those additional longs and additional shorts are offsetting so that you have a full exposure to the market at all times. But you can do the same sort of mean variance and mean variance leverage analysis for different structures for investors that are more risk averse, that don't want a full exposure to the market, you know, for a hedge fund type exposure, et cetera. The same sort of analysis can be done.
If you had utilities, oil and gas companies, which have a high degree of leverage embedded in the security versus, say, a portfolio of principally technology stocks which have low leverage, is that something you'd consider? Thank you.
There are all sorts of security stocks that have more leverage and stocks that have less leverage. There are also stocks that aren't, you know, there are ETFs where you don't bear any bankruptcy risk costs. And that type of analysis can be done based upon different types of securities, whether it's securities that underlying have a lot of debt in their structure, companies that have a lot of debt in their structure, or companies that don't have much debt in their structure. You will find similar conclusions to our conclusions in terms of the comparison of mean variance to mean variance leverage, no matter what type of security you're looking at. Now, some of the securities you're talking about, we look primarily at how volatile the security is. It's not necessarily the case that companies that have more debt are more volatile securities, which is, I think, what you're alluding to. One concluding comment is that you know, Mike had very eloquently had some very kind words at the outset, and it was nice to mention my wife and Ken's wife, Eileen and Freda, and I turned the favor around and thanked them. But being a quant, I thanked Eileen and Freda for their tolerance and for their patience, but I think I should have thanked them to the square power, or maybe the fourth power, for their patience and their tolerance. Thank you very much.